and welcome. My name is Piers Ridyard, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, and I am on a call with Dan Hughes, founder of RDX Works and one of the brains behind the creation of the public ledger Radix. It is great to have you on the show. Today we're going to be doing AMAs. We've got a few that are have been pending for a while since we haven't been actually able to connect. I've been traveling and doing things, and you've been traveling and doing things. So it's been a little bit of time. So we've got a little bit of backlog. We are going to go in reverse chronological order, controversial, because there are some things that are more timely that have happened now. So if we left them later on, they would be less timely. So we'll go through in that order. So first of all, we have a question from Maximus Gerthian. It's a ridiculous name.
It's a great name.
Oh God! On Telegram, which the question is: can Dan do a GT Academy AMA or stream? It'd be great to talk to him, talk about the team and the dream. So, can you give a bit of background on this, Dan, and then talk to this question?
Sure. So, as you all know, I'm a complete petrol head, and I used to do a lot of like track days and racing, drag racing, and stuff. I was even aspiring to be a rally driver at one point in history until I had a big accident. Couldn't do it anymore. Right. And then I used to like do a lot of stuff like racing, motorsports and things, you know, going along to race days, going with friends, participating where I could and stuff. And then this came along and I literally haven't been to a track in like, you know, a proper race weekend for a decade.
Right.
And then Michael Johnston, who you all know is the driver that drives the Radix car, reached out to me nearly 12 months ago, aspiring racing driver, got a lot of skill, looking for sponsors. Me and him had a chat, hit it off. His pitch was amazing, by the way. He kind of crafted this newspaper mock-up where he was on the front with a picture of him holding a trophy, and he'd written a bit of a mini like news report about Michael Johnston and Radix and blah, 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 blah. So it was like, okay, this guy deserves a phone call just for the effort he's put into this pitch. So I had a chat with him and we kind of hit it off and we were just kind of talking about cars and stuff. And so I agreed to sponsor him. And I wanted to kind of keep it separate from Radix. I wanted it to be my own thing, right? A bit selfish, but I wanted it. So kind of got things rolling, and we got a car and we got a support team, Century Motorsport, that provides all the support functions, right? So pit crew, car maintenance, tuning of the car, etc., etc. So then all Mike has to do is turn up and drive, and all I have to do is turn up and watch and give him support, etc., etc. And so this year we're racing in the GT Academy, which is like a slight step down, I guess, from GT4. Because while Michael's got a lot of skill, he hasn't had a lot of kind of racing experience. So didn't want to go straight into GT4 this year. Wanted to just get some seat time and just get into the rhythm of things again. But as many of you probably saw in the Silverstone race, maybe that's not the case because finished P5, P6, and that places him at 4th position right now in the championship. Right? So a lot can change, but it's a really good kind of, you know, for a kind of rookie, I guess, with not much racing experience competitively. It's a really good start. So there's some more races and stuff this year. There's Donington Park, there's Alton Park, there's Brands Hatch, there's Snetterton. And so hopefully, you know, we can pick up a decent amount of points, maybe get a podium in there somewhere. And, you know, he's got TV coverage and everything. So it's really good exposure for Radix, even though it's kind of not officially associated with Radix, right?
Right.
Put anything I wanted on the car. Why not that? And kind of moving forward, I guess the next year I want to move up to GT4 if possible. There's a seat in the car potentially available already, which would be a BMW M4. So just move up a class to GT4, and you know, see how things go. Move up to maybe to GT3, and then ultimately Michael's dream is to do Le Mans at some point.
Is that so? I didn't realize what the top of that is. So the top of it,
yeah,
is
you kind of the trajectory, I guess, is like you move up the ranks of the GT racing, and you essentially kind of your pinnacle is Le Mans, which would be super cool.
So you're basically nurturing talent here, nurturing
because I'm not able to do it myself, I guess, because of injuries from that car crash, which you know all about, right? It's far too painful for me to do anything other than straight line drag racing, really. So the best option is for me to nurture, watch it from afar, enjoy the racing, enjoy the day, enjoy being on the pit lane with the crews and all that kind of stuff, and get to know people. And it's good for business as well, right? So there's some high profile people that go these race days and stuff. So be able to spread the Radix word and these in the paddock and stuff as well. So
that's really awesome. So are you going to do an AMA or a stream on this?
I could do, actually. One of the race weekends.
Maybe get Michael involved as well and ask him.
Get him on. Yeah, do
how
some.
He got involved with Radix.
Do a bit more content as well.
Because he's a Radix fan, right? He reached out because he's a Radix fan.
Yeah, he's been following Radix for a while.
Right.
And I just crypto in general. But yeah, he reached out because I guess on my Twitter profile where it says petrol head, he's like, that's the guy I need. So yeah. So next race day, I'll report a bit more content. Yeah. I was just a bit in the moment at Silverstone, so I didn't have any real content. I just just enjoying the day, right?
Right.
And I wanted to put a bit more up and take a video doing on the pit lane and stuff, and all the bits and pieces of a race day and go a bit of a commentary. But I just got in the zone in the moment, so.
Nice, cool. All right, well let's move on. I'm sure that anyone who wants to drop in on that can drop in on that when you've managed to get that together. So next question is by Charles, also from Telegram. What do Piers and Dan think of the current UST Luna saga, and what do they take from it in regards to potential Radix stablecoins?
For me, I don't know about you, Piers. For me, there's not a lot of takeaway in terms of like fundamental things to learn, right? Stable coins are hard. We know they're hard. There's a reason we haven't launched one, even though like individually for me and also collectively me and you have been looking at these things for a number of years now, right?
Yeah, I mean, they were the thing that we actually bonded over the first, right?
It was, yeah.
And it was around stable coins that we were talking, not consensus at all.
And even before then, of course, some of the OG Radix stroke e-money guys, as it was then, will know I've been looking at this stuff and playing around with things since 2013, 14, and it's hard to do because you're relying on actors that you have no control over,
right?
To in these kind of algorithmic stablecoins anyway, right, where you're relying on arbitrage or collateral or swaps and all this kind of stuff. You're relying on actors in the majority to be working in the best interests in the system,
right?
Even though those interests have some incentive for them, right? So arbitrage can make some money, and fundamentally your stablecoin algorithm only really ever has a partial view of the information. It doesn't know for sure. It can't be objective around, okay, so why is this particular person just gone and bought 1 million Luna, right? Is there some play here? It just can't extract that information at all. And obviously the reason why you have these kind of complicated game-ish theory economic models for stablecoins is because it's very difficult to extract objective price shock information out of a trading pattern because it gets obfuscated. You don't know which one is moving.
Yeah.
So
I think I actually did take a few things away from Luna. They were sort of like reinforcements of some learning and thought processes, and then like sort of like a really
reinforcements. It just further yeah, this is hard, right? These things are difficult. There's always a death spiral somewhere.
Right. But I think this is the thing that we need to be as an industry more intellectually honest about is I think every stablecoin system design I've seen has said, well, if a death spiral occurs, right, it's like, then it fails. And it's like, well, there should potentially be the consideration of what a elegant failure model looks like. Like, is there a point in which you go, okay, like, I mean, for Luna, right, there was an infinite, it got to an infinite mint cycle where Luna just like hyperinflated essentially. To save UST, but like, is there a point? Like, can we model out and say in failure cases, if this threshold is crossed, then this thing happens, and this thing is a bounded case rather than an unbounded case, and this bounded case means that everyone's loss is limited to X rather than, you know, whoever's the fastest person in the system to spot the death spiral and get out is the people who get away okay, but anyone who's slow, which is normally the consumer, ends up, you know, getting screwed. So I think that a lot of these systems think about death spirals as going, oh, death spirals could happen, and if they do happen, that's it. I think in the same way that when you think about financial institutions and making sure that financial institutions, like there was a bunch of legislation about this actually, about like making sure that financial institutions understood how they could be broken up in the case of bankruptcy because of the whole Lehman Brothers debacle and how difficult it is to unwind everything. I don't know whether or not that's possible to apply here. It may not be. The other thing that for me is that reinforce this idea that secondary markets move market cap way more than people realize they do, right? So like, you know, a 10 million dump can move the market cap $100 million.
Oh yeah.
Right.
Yeah.
Because it's all down to depth of liquidity rather than, you know, sort of market cap. And what a lot of these
cap means nothing. I mean, like if you've got 3 to 5% of any cryptocurrency, you can put the price wherever the hell you want it. Even right. Bitcoin. If you've got 3 or 5% of Bitcoin circulating supply, you can paint a pretty picture on that chart.
Right.
And market cap means nothing there.
And I think that's the key, and that's what all stablecoin designs that I've seen
don't consider for that.
Don't consider for this at all. They don't think about secondary market liquidity, and that it's the secondary market that is the important part of the system to watch, rather than sort of like the mint burn function, because the mint burn function can have a huge effect on the secondary market if you're not concentrating on the liquidity aspect of it. Now, I'm not saying that the team, Luna and Do Kwon, weren't thinking about this, because they were. Like, that's why they raised the LFG fund. It's why they were like trying to get their token from the 3 pool to the 4 pool and like massively increase the liquidity there. And so they were certainly considering it, but that combined with the unbounded infinite mint meant that the death spiral actually was very violent, because as soon as Luna became inflationary to the point where people are holding Luna were like, well, screw this, I don't want to be holding an inflationary asset, and we're exiting as quickly as possible. You then had this, well, I'm unbounded in how much this is going to cost me, so I'm going to rationally decide to get out of this asset and dump it on market, which means that the market cap of Luna crashed so rapidly because of the secondary market and the effect that, you know, sort of people dumping on the market had, which then had this another effect of basically meaning that people were getting very large amounts of Luna for their UST that they were burning UST to get Luna for, which then increasing, I mean, just so create this hyperinflationary cycle, right?
And there's one thing that I think is missing from all of these stablecoin algorithms as well, right? So you were talking there about a rational investor, right? Shit, this is going down, and I need to just it's clearly crashing, right? It's not just, you know, a short term like blip of panic. It's like, this is actually crashing out, right? And this is in a death spiral, and there's no way that this is going to stop until it literally hits zero. So your rational investor is, of course, going to try and extract as much value as possible and safeguard as much of their investment as they possibly can.
Right.
But what you actually don't have in the system, you don't have an irrational actor that doesn't care about preserving its own value or wealth, right? And if you had, so it's unbalanced, right? You've got rational over here trying to preserve the investment, and you've got no irrational actors over here. But when the system is healthy, you get rational and irrational actors on both sides, on the same side, right? And they kind of balance each other out. But you have, in a crash scenario, I'm not sure if this is coming out making sense, but it makes sense up here, right? But in a crash scenario, everyone's rational and no one's irrational. And so what you potentially need is even if it's a synthetic or algorithmic form of the irrational that will try and save the system no matter what. That you don't have that.
Yeah, so I've been thinking about this a bit, and I think that one of the I'm not sure it's an irrational actor, but it's an act.
It behaves like an irrational actor to kind of balance it. Right?
So I think this is where hedging comes in. Like, options and derivatives have not got massively sophisticated in the DeFi space yet, but like if you're able to buy put options on the underlying collateral, and you're able to buy them before the event occurs, but such that they're enforced during the event. So basically you're trading your long tail risk away, right? So you're paying for someone else to take the long tail risk. Then at the point that they sell the put option to you, they're acting rationally in that there is, this percentage chance of it happening and this percentage chance of it not happening. And they take the rational decision at that point, given that information, to sell you a put option. And then the system itself is able to hedge against its long tail risk in the case of a crash, which then gives you an external party who, in this case, isn't acting irrationally. They're acting according to the contract that they sold you to be, to take this other side. But a lot of the option markets have to be a lot more liquid than they are.
Well, that would allow the algorithm to act in the opposite to your retail,
exactly,
which is what's missing. Yeah, so irrational is maybe wrong, but because like you always need a fairly coupled balance of opposite, right?
Right.
This is happening over here. You need the opposite to happen over here in an economy for it to balance. But in a crash scenario, you don't have that in these systems right now,
right? Because
the system has nothing that it can use. It can't use anything in order to try and balance those scales. But with put options and futures and all that kind of stuff, the system has something it can use. It's like, well, I've got this level of capital available to me that I can kind of backstop against up until this point in time to try and resolve and balance this movement back out again. Yeah,
so I think that there is the possibility of building some systems that have hedging scenarios built into them. If you have if your collateral is not stable, right? If you're building a collateralized stablecoin, I do think fully algorithmic stablecoins are a bit more problematic. You can also hedge positions, but the problem comes in the death spiral point, in that you have.
What did surprise me, actually? What did surprise me is, I thought that all the Bitcoin and stuff reserves, I thought they would actually prop it a little bit more than it actually did, right? But that just ended up tanking out every other market out there rapidly, right? And I didn't expect it for that to be that violent either. So I mean, it reserves in other denominations maybe have also been shown not to work. That's probably actually we told a lie at the beginning. That is probably the main takeaway for me, is that your reserves, if they are in other assets, may not have any effect whatsoever.
Potentially. We don't know yet. We're not sure yet what the LFG fund, at least I'm not sure. I haven't read anything of what the LFG fund actually did during that period.
Apparently, the news on the Vine, according to their own statements, is that they've liquidated pretty much everything that they could.
Okay. So catching the
Multiple
falling
billions.
knife. Tried to catch the falling knife and it didn't work.
Yeah, and it just did nothing. All it did was drag Bitcoin, Ethereum, everything else down.
Right. But I think it's I still think that stablecoin systems are. So first of all, I think that stablecoin systems are going to be important, and Radix continues to research them. But second of all, I think that they are still very primitive in how they're designed, and I think that we've got long way to go.
Stablecoins are really a must for DeFi to go properly mainstream with your retail investors.
Right.
Like even if it's just a peg, and a simple peg, and none of these more exotic methods like baskets or algorithmic stable things, whatever.
Right.
But they're incredibly important for DeFi.
Right.
And even the simple pegs, they're hard.
Yeah, and we've got things like USDC and USDT, and that's cool. But the world doesn't run on just the dollar, and there's many countries who have made explicit announcements that they are not going to let currency representations be issued from their country. So Thailand's a great example of this. The Thai baht is not, at the moment, with the current government, going to be ever be a representation on ledger that has been issued backed by Thai baht. So if you want to get a global audience online, you're either forcing them to use a currency that's not familiar to them, or you have some decentralized representation of currency they can use that is in their currency denomination. And so there's going to be this battle between consumers wanting things and government, because this starts to touch on lots of things that governments get worried about, such as currency controls. If you have a currency controlled country like Korea does, and like Thailand does, and like Singapore does, and China does, and so there's going to be this really interesting battle that occurs between stablecoins and states. And again, this is another reason that we are very cautious about how we think about stablecoins, or how we would think about deploying stablecoins, because I've always said this, this has always been part of a conversation that me and Dan have had, is what we've created with Radix is incredible on its own. It doesn't have to have an extra thing to it. We just think that stable coins will help mass adoption. But if we can't come up with a model that works, or would put too much risk on Radix, on the public ledger succeeding versus the benefit that it provides, then we just won't do it.
Yeah, we don't want a Luna situation, right? Where all the risk of the stable coin is on the native token,
right? And
a failure of the stable coin is also a failure in your native network. That's the last thing that you want to have.
Right. Let's move on to the next question. So the Rect 4 blog was great. Oh, so this is a question from Discord. The Rect 4 blog was great, but it raises a few questions. The blog implies that with Babylon, the Radix app on Ledger will display the actual transaction manifest when it asks the users to sign a transaction. Will this require an updated version of the Radix app? What is Ledger's policy on accepting app updates? Is it possible their policy might mean we need to start the approval process with side loading? Does this mean that the required schedule for Babylon is dependent on something done by Ledger and beyond our control? Is someone at RDX Works actively working on such an update that can be released and added to Ledger's pipeline ASAP, or am I worrying about nothing? So I can answer this, and the answer is yes, it will require an update to Ledger. Yes, we are already talking with Ledger. No, going live without Babylon is not dependent on Ledger's integration, and you will see why, because we are changing more. There is a new account model on Radix as well, which means that hardware wallets become less immediately critical to the use of the platform, but you'll understand more about that when we get closer to Babylon. But yeah, I think that the hardware wallet as a paradigm that has to be the basis of your security, that will continue to some extent for some users, but it's not going to be critical for every user on Babylon if our view of how the account model system works well. But yeah, like Ledger's been fine. Like they've been. We got through the process of the first approval. We feel like we understand it a bit more now, and we will make sure that the second approval gets as timely as we can work it on it with them. Which will be first time we can do that is probably somewhere between AlphaNet and BetaNet, which will give us a good 3-month run at making sure that Ledger is ready for the switch over. And yes, the transaction manifest will mean that you can see all of the things that you're signing, and we think that's going to be really cool and really useful for end users. And I'm pretty excited about that.
Always freaks me out on Ledger when I'm sending something over Ethereum. It's like an ERC20, and it says, "Hey, you need to blind sign this thing," and it's like, "Oh, really?"
And like blind signing gone, right? Now you will see each part of what you're signing and what it's for. And like those who've used the Olympia wallet will already have seen that, you sign the transaction, it tells you what the transaction is, and then you sign the fee, and it tells you what the fee is, and it's all nice and human readable. And that's just going to be extended, and you'll be able to see like all of the different things. So if you've done a very complicated transaction, you'll be able to see all the things that you're signing for, all the parts of it, which again is going to create much more secure user experiences and make sure that people really understand what it is they're signing, because on Ethereum you don't, and that has caused lots of problems for people.
Yes, it has. And many seasoned crypto guys have had many close calls because of it as well. And it's only because of their experience and paranoia they've been able to avert some serious losses.
Right. And some seasoned guys have been caught by it.
Some seasoned guys have been caught.
Like famously the Nexus Mutual, right? Like got something like $20 million worth of Ethereum.
You have to win every time, and they only have to win once.
Right. It's terrifying. Question from Juris on Discord. I was just reading about the reasons for the unstaking delay with for another member's question, and it came to my attention again that the delay period may be temporary. My questions are: when will the more automated mechanism become available, and are they being worked on right now? If there are no plans to change the delay period, what is the reason for this? After these mechanisms have been implemented, when the community will be able to vote on unstaking, when will the community be able to vote on an unstaking delayed length they deem acceptable? So there's no plans to change the delay itself at the moment. Dan will be able to talk to why there's a delay. The only thing that we were looking at was this idea that you could choose the next node that you wanted to stake to, so that when the unstaking happened, you would then stake to a different node. But there is a good reason for the delay, which Dan will now espouse.
Indeed. So, I mean, it's all to do with one, obviously maintaining the security of the network, and two, preventing your dishonest actors in the system essentially being able to chase around very quickly the best place to put their stake in order to influence outcomes of consensus. So if I was able to say, for argument's sake, unstake immediately and stake somewhere else, then if I know, let's just go with Olympia, right? If I know who the next leader is going to be, and whoever that is just happens to be my buddy, and me and him have a fairly large amount of stake floating around, not enough to control the network, but a fairly hefty amount, then I'm able to, if there's no delay, I can just move my stake from wherever that is, maybe it's my own validator, and I'm able to stake it immediately to theirs on the round before they become leader, right? And then whatever that leader proposes and the leader votes upon, that it has some greater influence than it would have already had, right? So depending on your validators and what they see, and if there are any conflicts with things that are currently being dealt with, et cetera, that additional boost of my stake on their validator might just be enough to swing the vote, right? Now, obviously, if you've got a lot of people doing this, then and you can unstake quickly, you potentially even by being allowing immediate unstake or short duration unstake, you might inadvertently create a market there where people will charge unruly validators to move their stake to various places, right? I will give you $10 if you will move your stake from here to there for the next 15 minutes. Okay, cool. And then I also get earnings and whatever else I might get. But there's potential for you to create a stake market where people who are grey, let's say, are willing to make a little bit of extra cash on the side. But if you have a delay, it avoids that. Now, some systems it's not quite as critical because your leader election may be different, maybe a bit more complicated, or your consensus mechanism is a little bit different. But for Olympia, we need the delay to be quite long. That may change, may be able to be changed and shortened somewhat over time as we progress through the different iterations, and we can do some analysis and run all the game theory stuff around those kind of attacks again. But we'll always need one. There will always have to be one because it's just too easy otherwise to move large amounts of stake to a particular place where it can have some significant influence.
Right. And then there's the other thing about maintaining security, as you talk about, which is like a lot of attacks that occur on top of like a double spend attack could be not detected immediately. And so you need some kind of delay to allow you to detect and the algorithm to come to the decision that is actually a double spend and then slash that person. And that can...
Yeah. And there's another avenue as well, right? So you've kind of got this fee market, and it may be cheaper for me as an attacker to pay everybody who's got a significant amount of stake $1,000 to just destake it for half an hour,
right.
Drop the amount of stake tokens in the network significantly,
right.
Then mount my double spend,
right,
or
right.
my double spend attempt,
right.
And then all the people that would have got stake would potentially have got slashed. They don't get slashed. They've got $1,000 in their pocket. And there's some double spend. I mean, the irrationality of that gets called into question, but
ultimately, staking is a critical function of the ledger. And as a result, you are providing a service to the entire network, and you are paid for that service in new tokens. But the cost of that service to you is staking delay and potentially getting slashed as a result of being dishonest. And as a result, those decisions are not arbitrary decisions that should be made by a community vote. Those are questions that should be done on the basis of some very conservative estimates on what is the worst case scenarios that you're trying to prevent, rather than how can you make it really, really easy for people to switch.
Yeah, it's a long thought process and analysis, right, to come up with a staking delay chain.
So 2 weeks is sufficient. If less than 2 weeks is sufficient, that decision should still be made very slowly, and it should be made well after we have a full design for what staking is going to look like on Xi'An and things like that, because we don't, when Xi'An is added, this adds a load of complexity to this as well, because of how Xi'An works. So 2 weeks is not going to be changed anytime soon. We will try and make it easier to switch, so that if you're with one node and you want to switch your stake to another node, you don't have to come back on and now you're unstaked, select a new node to stake to, that you can just go, okay, I want to destake, and then when it's available to restake here. But again, that
just a move button.
A move button.
Okay, this is going to take 2 weeks.
But
cool.
there's still going to be a delay, and during that period, your stake is still tied to that node for everything that's done up to just before your unstaking period, and then your unstaking period is essentially the rest period to make sure that no dishonesty happened. And I can't guarantee how easy that move is going to be. I know that the tech team has looked at it a couple of times, but it's non-trivial, and will definitely only happen post Babylon if it happens.
It sounds simple, but it's a stateful action, right? Because you're saying, I want to destake this, and now I need the ledger to remember that I want to move it there later.
Right.
And so your destake is triggering a consensus action that needs to happen in the future at some arbitrary point in time. Right. And the network configuration may have changed, the leader election may have changed, the network has maybe run faster or slower, it might have had some downtime, whatever, right? So even though it seems like it's simple, it's actually quite difficult.
As with many things in consensus, I have learned.
Yeah, everything seems simple, and then you get to it and it's like, oh shit, this is actually really hard.
Okay, next question by Blend from Discord. Vitalik once criticized Bitcoin for having fees as high as several cents. How do we know?
How dare he? Several dollars now, right? On Ethereum.
I feel like so much that is said in this junction at this time is going to be like the Bill Gates being like, I don't see why anyone would need more than 1 megabyte of storage, or whatever he said. Vitalik once criticized Bitcoin for having fees as high as several cents. How do we know that gas fees on Radix will remain low in the future, Dan?
Well, we don't know this. But one thing that we can do is we can ensure that the throughput capabilities of the network are to such a degree whereby for your fees to get to a point where they're unbearable, the network will have to have been doing tens of millions of transactions wanting to be processed at any moment in time. So, it's like you think about Bitcoin, Ethereum, et cetera, and it only takes a small amount of people wanting to do something at a particular moment in time for the network to become very saturated and for the fees to increase because, they can only handle 10, 15, 20 transactions a second. But when you're thinking about very high throughput networks, right? So, let's say that Xi'An's baseline is 1 million just for argument's sake, right? To saturate that network, you then need another 1 million people to come in over a short period of time, and that's a lot more unlikely, right? It's much easier for another 20 people to come at a moment in time that want to do a transaction on Ethereum than it is for another 1 million people to come in at a moment in time on a high throughput network to create so much demand that the fees increase. So it all kind of just comes down to like scale, really, right? And economies of scale and stuff like that. The bigger something is, the harder it is to make spikes because you just need so many more actors, so much more capital, liquidity, whatever, moving at the same time. It's difficult to.
Yeah, I mean, it's even more than that with Xi'An, right? Because consensus is in parallel apart from those things that are concerned with sequential actions. Like what you'll see is you may see fees spiking for some actions on ledger. Let's say that there's a highly contested pool on one of the dexes for one of the pairs.
Yeah, you might see localized. You'll see
localized fee spikes, but like seeing a net-wide fee spike would require a huge influx of users.
Well, even then, that's still harder to do, right? So, I mean, if Cassandra is any indication of any kind of performance that you'll see in a local validator set on Xi'An, let's just say for argument's sake right now that it is, right? It is somewhat reflective.
Yeah.
Then you're going to need to have a Cassandra validated set, and I can handle about 300 to 400 transactions a second. Right. Simple stake flips or like simple DEX swaps or something like that, right? So you would have to double that on that particular application over a short period of time again. So even though it's a lesser number, it's still an order of magnitude more people you need to suddenly want to do something than you have on Ethereum, right? So you would need to go from like 300 transactions a second up to 600 for that locally for that application, which again, right, it's harder. It's less likely for that to happen than it is for 20, 40 people to come along on Ethereum and say, hey, I want to swap this now. Right. So the bigger your network, the harder it is to saturate, basically.
But you're always going to have, as you say, if you have spikes, you're going to have higher fees, and until such time as more capacity can come into the network. And at that point, then the fees will go lower again, until such a time as you have a higher spike, or that baseline is uneconomically sustainable for the number of validators that you have, and some validators decide to switch themselves off, and then you have a lower baseline again, and then you can have a spike. Like, it really depends on what usage looks like, and anyone who's run servers will be familiar with this problem, in that you have a certain number of servers that are just to deal with your normal traffic, and then sometimes the traffic goes crazy and your servers can't deal with it, and people are like, well, why did you not foresee this? It's like, we did. Those servers were operating at 30% of CPU and resources and IO, and then all of a sudden now they're at 100. So we had a nice margin for unexpected requests and stuff. Obviously, as well, the benefit that we have, as do some other sharded networks, of course, is that the problem with Bitcoin and Ethereum is that they're kind of hard capped at that 10, 20, whatever, right? Whereas if your increase in demand is gradual, so it's not just a short spike, it's gradual, then the network can reconfigure, and more validator sets can be added that are serving smaller ranges of shards. And so you can increase your capacity in line with what your kind of your average demand trend is. So if it's just steady demand, then you can always get in front of the fee spikes, because the network's not going to hit a saturation, because the scaling of the network is in line with the scaling in demand. Yep. So you should only see short-term fee spikes. And fees are going to be like, ultimately it's a market, right? Where like if people if there's something of value to gain, people are willing to pay up to that value less some minimum margin to get that thing. And so what we've already seen on that, like networks like Solana or networks like Avalanche, is you reduce the fees, you increase the transactions, because now there are more opportunities that were not profitable on Ethereum because the fees were high, that are now profitable on Avalanche or on Solana. And so people are doing more transactions because it costs them less, so that they have more margin available to do the smaller arbitrage or whatever. So you're always going to see at some point some form of congestion on any network, doesn't matter how scalable it is. The question is how much can you increase that baseline to make sure as many users under normal scenarios can be using the network at reasonable cost. But we cannot guarantee low gas at all times, because it is the very nature of the economic systems that are being built here.
Also remember that fee spikes are good, because the fees get burned. So UXID is worth a little bit more.
True story. Okay, next question by Dominic. Are there any ideas on the instapass service for dApps already? Will there be identity NFTs? Is there a timeline that this service will comply with other countries in the world other than GB? So this is a good question. Like, we are still in the early stages of instapass as a service for third parties, and that's really not going to go live until after Babylon. For using things like InstaBridge, we're learning a lot about how to build compliant AML KYC within the jurisdiction of Jersey, which has to fall under the same anti-money laundering regulations that the EU has to do. And the EU is one of the stricter places in the world for that. You still do have to go jurisdiction by jurisdiction and work out sort of whether or not your process is compliant with that local jurisdiction. But as the EU starting from a very high bar, both in terms of what is allowable under AML 5D, which is the anti-money legislation in Europe, or under the sort of like GDPR, so like how you actually have to protect that data when it's been stored, and how you have to make sure you have compliant systems around that. So there's lots of learnings going on there. It is not a small undertaking, but the whole point that we want to get to is make this as easy as possible for users and DeFi dApp developers to be able to integrate this into their system so that they can do sort of like compliant DeFi and compliant services for their users. So there is no timelines on this, save for the fact that you can see this working as a product in process on InstaBridge, and know that every month that we are doing that, we are getting closer to being able to build this kind of service for external parties as well. Okay. Vlad, question by Vlad on Telegram about privacy. And I think this is going to be our last question. So, can we speed up private transactions? It seems a bigger request from businesses than anticipated and therefore for adoption. I'd say it's more important to have even than 50 transactions per second before Xi'An. Can we build even more than 50 transactions per second before Xi'An? Can't we build e-commerce, for example, with full transparency? We can't build e-commerce, for example, with full transparency, not to mention the more sensitive transactions for businesses that need to keep the flow of their money private. Can we build some faster workarounds maybe on Babylon, like deposit pools to mix transactions, or ZKSnarks? We were chatting in the community about scrypto computers that might just do this, just this private transactions. Dan, private transactions?
They're hard to do. This is the issue. They're hard to do and they're expensive to process. So, if you had all of the transactions were completely private, anonymous, blinded payee, sender, value, etc., then you could that 50 TPS will turn into 10 purely because of the amount of computation required to validate those transactions. So they're not cheap. They're also not easy to implement because most of the transaction privacy models that really offer strong anonymity, strong blinding of value, etc., they're stateful, which means that you need to remember something about each private transaction on Ledger, and that's workable to a degree on unsharded systems, but not unsharded, because everybody then has to remember a little piece of information about every private transaction in the system, right? And so it just becomes unmanageable. If you have a sharded network that's doing 100 million transactions a second, and 1 million of those transactions are private, then everybody in the network has to remember something about 1 million transactions a second. It doesn't work, right? Besides memory and storage requirements and all that stuff, just that information blur just doesn't work. ZKSnarks, again, they're not a silver bullet here. They're expensive to produce. Even though there's been a lot of development on making that more efficient, they're still insanely expensive to compute and also to verify. So again, not something that we would want to be looking at scale, is processing many snarks and stuff. And again, snarks probably wouldn't work very well in terms of sharded, because you can't easily batch things together, because you've got all these unrelated private transactions everywhere, but you have a unpredictable set of validators that have to validate that said snark. So you actually I don't even think they would work, because most of the snarks that you want to validate, you're only looking for one thing. So receiving a snark that constitutes hundreds or thousands of things is inefficient, because, hey, I'm only responsible for this one. The other 999 that are in this snark, 100 other validator sets are responsible for those. So it just gets very complicated to do. And even with simpler anonymity models, like using Peterson commitments and stuff, and sharded, it gets complicated as well. And obviously what we don't want to have is, we don't want to have some anonymity model that works on Babylon that doesn't work on Xi'An, because then you've got a real headache where all of the applications your developers have made now can't it doesn't work anymore. So anonymity, as nice as it would be, again, is another tough cherry.
And I've heard this argument around like privacy being essential for businesses a lot. Like, it was one of the reasons that one of the like principles that R3 Corda built themselves around, this idea that, now we have a way in which you can decide which parties in the quorum are actually party to the transaction and all this kind of stuff. And what we're seeing is actually the norm towards, or at least what I think I'm seeing, is that the norm towards pseudonymity on top of public ledgers, from the point of view of capital markets, where there is greater yield available, where there's greater opportunity to deploy capital, it's a price that most businesses, most financial institutions are starting to be like, yeah, okay, fine. Like, you're seeing the hedge funds and people like that coming into DeFi. You're seeing the start of things like Aave Pro, which is like a walled garden that allows you to come in and out. Like, these are institutions that are now using public ledgers where their transactions are visible on public ledger. In a pseudonymous way, but still visible. Now, privacy is going to become more and more of a thing on top of these public ledgers for sure, but it's not this wave, and it's probably not next wave. Like, scalability, usability, and regulatory compliance is all coming before privacy, because privacy starts to be important when you have huge numbers of players on top of these platforms, where you have large, and then you have data analytics services that are actually trying to break anonymity and doing so in a way that is harmful to the privacy of the individuals, which again, I think is going to come. Unfortunately, it's just the nature of, people go, it's all public, so I can start doing this stuff. And then they start publishing information about what people are doing. And at that point, privacy is going to become more important, because you're going to get the smashing together of these two worlds of like GDPR and, privacy by default, and then these privacy networks. The other problem with privacy is that you put yourself smash bang against the regulators at the moment, who don't like privacy coins, who don't like privacy transactions. So like, at the moment, regulators taking the stance that if it is a privacy enabling network like Monero or Zcash, they don't even want exchanges to list them. So like, if you have privacy in your system, you actually create a massive business disadvantage to yourself to getting on exchanges and being integrated into places where people want to use the tokens as a form of as an exchange token or a store of value, because regulators are currently going, well, if you can't do chain analytics on it, not interested, right? Like, it's not compliant. That's going to change, in my view, because I think that the approach that's being taken is like a sledgehammer to crack a nut. I think that what the requirement to go through the entire transaction history of a token based on that transaction to you, going back multiple hops behind multiple addresses, I think that's probably actually not fully in compliant with the privacy legislations. Like, I think that the regulators and the privacy legislation, now regulatory AML sits above privacy legislation. Anyone who's tried to do, a data deletion to a bank will know that when you go into the bank and say, I want you to delete my data, they go, sorry, can't do that. Our regulatory requirement to store your data based on the transactions you've done exceeds your personal data protection requirements to right to anonymity and right to deletion, right? So that there is this battle of who gets supreme. Is it the people who are trying to stop money laundering? Is it the people who are trying to preserve privacy? Personally, I would love these networks to support privacy. I think privacy is a human right, and it should be something that everyone has access to. But for all the reasons that Dan said, from a technical point of view, really, really difficult. Not impossible, but just like the next problem that from once you have the baseline performance that you need to be able to address.
Yeah, from my own point of view, privacy is important for many of the reasons that Piers states, but also I've got my own opinions as well. But it's one of those things that I wouldn't spend the time designing one that would work in a sharded environment until I knew exactly what that sharded environment looked like. And right now, Cassandra is a kind of peek through the keyhole as to what Xi'An might look like, but it doesn't mean that it's going to look exactly like that. So while I could design one and maybe it would work on Cassandra, it doesn't mean it's going to work on Xi'An. So that's kind of pushed out to post Xi'An, where everything is defined, everything is implemented, everything is in place, all the components of the system are there. And then at that point, I would spend some serious time looking at, okay, how would you implement privacy on top of this sharded network? Is it even possible? Because I don't believe that anyone's done strong anonymity on this sharded environment as of yet.
Yeah, and I think there's also the question of whether or not it's by default.
It raises a lot of challenges.
It raises a lot of challenges, but there's also a question of whether or not it's by default, i.e. everything is private, or if it's an application that uses some, sort of primitives that the ledger supports, right?
Yeah. I mean, my intuition says that you can mix, so you could have anonymity optional for certain things if you wanted. Right. Kind of dip my toe into that a little bit in the past when looking at just anonymity as a not to build anything, just an interest, right? So my intuition says that it's possible to have both. There might be a bit of friction in between going from non-anonymity to anonymity, but really the main question is, can you do it in a sharded environment? Right. And can you provide strong anonymity in a sharded environment?
I still have flashbacks of you trying to explain homomorphic encryption to me.
Yeah. I mean, and like the thing is as well, it's harder to keep a sender of a transaction anonymous than it is the receiver, right? So, because
I say right as if I understand that, I'm like, yeah, sure.
Well, think of it this. Think of it this way, right? I've received some UTXO, that's public on Ledger, and now I want to send the contents, the value of that UTXO, 10 Bitcoin, let's say, right, to you anonymously. No, but the problem is that everybody is already aware that whoever owns that address already has 10, right?
Yep.
So if that ever moves or changes, then if I send it out in an anonymous transaction, it's like, well, hold on, Dan had 10. His 10's gone via this anonymous transaction. Right. So that Dan spent 10, right? Who has it gone to? No idea. But so the receiver, it's easier for the receiver. The sender is more difficult, right? Which is another nice problem.
Another nutty problem to get our teeth stuck into at some point.
So even things like homomorphic encryption and stuff, and what they call stealth keys and stealth addresses work great for the receiver, but they don't work for sender.
I think we'll leave it there. Thank you everyone who asked questions. We do have a bunch more to go through, so me and Dan will be having another session soon to carry on going through, but please keep them coming, and don't forget you can also ask questions. So a few of the questions that were in here are actually going to go to the round table that we have sort of once a month. So please do ask roundtable questions for sort of everyone in the leadership team, or questions just for me and Dan to walk through. But thank you very much for your time, and thank you very much, Dan.
Thank you.